Hello, everyone. Welcome to our first webinar Wednesday of 2026. We are joined by our speaker today, Eric Lair, who is the Chief Revenue Officer at Reseda Group. Eric leads growth strategy, partnerships, and brand innovation, helping organizations turn member-focused initiatives into measurable and sustainable revenue. And with that, I will hand it over to you, Eric.
Thank you. Appreciate that, Amanda. And good morning, everybody. Thank you for taking some time to walk through what we're going to discuss today around utilizing financial wellness as a more of a strategic investment and to build how to show you how to maybe take a look at it where it can begin building an ROI that makes sense to your leadership team, to your board, etc. I mean, we all know that providing financial wellness and education is absolutely central to what we do as credit unions. It's a perfect fit for how we want to engage with our members and for providing that value-added service that we need to be able to deliver to our members day in and day out. But the trick with financial education, what can be challenging sometimes, is moving from the it's the right thing to do to it's a financially beneficial thing to do for not just my member, but also for the credit union. And that's what we're going to talk a little bit about today. We've given some thought to this within Reseda Group, within Michigan State University Financial Credit Union. And we're looking at how we can continue to invest in financial education for both the credit union and for Reseda Group. Reseda Group, we're a wholly owned QSO of Michigan State University Credit Union. We are 100% owned by MSU-FCU, and we are focused solely on bringing solutions to the credit union and occasionally the community banking space to make sure that we can help credit unions embrace financial technology and utilize it to serve their members' needs because members are demanding this capability. They're demanding that we answer the bell with financial technology. It can be a tricky area to negotiate, and we want to help credit unions negotiate that. To that end, one of the things that we're working on, and I'll get into the webinar here in just a minute, but we are very excited to be partnered with the CCUA as a provider of solutions within the credit union community, within the marketing space, within the financial education space, and other areas that we focus on. But we're particularly excited about a new program we're going to be rolling out right, imminently around a focus on small asset size credit unions and giving them the access to financial education and wellness resources that allow them to better serve their members at a cost that they can manage. It's a focus of ours. It's focused on small asset size credit unions. It allows that credit union in partnership with the CCUA to provide content to their members, blog content, video content, webinar content, calculators, quizzes. It has all of those types of podcasts, it has all those types of content available to the CCUA to share with small asset credit unions at a very aggressively priced space so that small asset size credit unions can take advantage of a robust financial education content system and one that is what Michigan State University Credit Union is using, so equal to a very large credit union's financial education platform. So when we think about financial education, financial wellness, how do we quantify the return on investment on that for your credit union? How do we drive that greater member credit health while at the same time driving meaningful asset growth and better financial performance? Because we have to be financially strong in order to serve our members. So with that in mind, we know that in the environment that we all exist in today, credit unions are being challenged to deliver more than just products. They're expected to improve their members' financial lives, and that's a big ask, but it's one that we have to answer. The fact is that most of our products, checking, savings, lending, cards, mortgage, they're those are commodities. Yes, there may be differences between one checking account and another, and fees and interest rates, but in general, the solution is the same, whether I'm doing it at a credit union, large or small, a community bank, a large bank. I'm still the nuts and bolts of what we're delivering are ubiquitous and a bit of a commodity. So how do we leverage our relationships and leverage what we do to do more than just deliver quality products, which they are? That's expected. That's the table stakes now. How do we deliver more to help improve our members' financial lives? And that's what we're focused on today. So we want to look at delivering financial health to your members as a growth strategy, as a way to improve your overall business dynamics. So when we looked at it, we wanted to see how we could utilize financial education and credit health to not just improve member credit profiles and reduce risk, but also to help deepen engagement and drive new loan origination. And so when we thought about it, we kind of thought about let's not, rather than throw everything out in regards to the member base, let's look at a couple of different cohorts and how we might be able to move the needle within that cohort. And whether you're a large credit union or a small credit union, focusing on a couple of key cohorts can be very beneficial. And you can do that without having to try to, as they say, boil the ocean. You can really have your marketing team, your financial education team focus on a narrow scope of people and try to move the needle within that cohort. So when we talk about the cohorts that we're focusing on, in this example, there's two cohorts. The first cohort is are people who are near prime. They have a pretty good credit score, 660 to 699. We will, credit unions will lend to them. They they're credit worthy. They have proven that they can manage their money, but they may be a little stretched, right? They may have a few challenges out there. And so the question becomes, how can we help move them? How can we help them move their FICO score up, targeting kind of a 740 plus? And what does that do for us? What it does is it helps improve net interest margin and helps reduce loan loss provision. So by moving that needle within cohort A from near prime, or you have a pretty good credit score, but you're not going to get the best rates, and you still have a little bit greater risk of credit issues. And then we still have to account for more money within the loan provision, the loan loss provisions. So how can we help move those folks up? That's one group. And then cohort B are the folks who reside just below that prime space, right? They're 630 to 650. And there's just something holding them back from reaching that 660 plus, where they're able to really become more active in regards to product usage within the credit union space. So with these folks, we want to try to focus on moving them from that 630 to 650, range, up into the 660 plus range, so that they are now able to take advantage of loan origination expansion, and new loans that might help them get out of a spot that they're in, help them consolidate debt, et cetera, right? So the idea is, let's find a way to help move those folks from that lower subprime, mid subprime into the near prime, and allow for them to take advantage of more solutions that the credit union offers that are built for them. So we know that credit unions are facing this competitive pressure, of a changing member expectation, right? We know credit unions are now expected to offer Netflix-like ease of use, Amazon interface, and an Apple engineering logic, so that everything is beautiful, every interaction is well thought out. And that's the expectation now. And the Amazons, the next Netflixes, the Wayfairs, all these companies that do a beautiful job of targeting their members and delivering what they want when they want it, that's become the expectation. So we have to try to meet that. We know that as we move more and more towards digitization, as our cohorts get younger, and we move to bring in a younger demographic within the credit union space, and as we see a rising delinquency risk, all of these are challenges that we face today. And we think that financial wellness and education is not just a member service, but also a way to help you build strategic assets, and to help better manage risk, and utilizing both of these as levers to growth. So when we talk about financial wellness, what it means is tangible member behavior change. How do we change the member behavior to put them in a better financial health position, improve their credit union credit worthiness, and how do we help them and help us drive new asset generation opportunities and growth opportunities within those bases, within those cohorts, so that they're better able to take advantage of solutions that meet their needs. We know we're the best solution for our members. We know that we're looking out for their best interests. We know that we have the best rates and the best solutions and the best engagement. We just have to find a way to make more and more of that available to our members, and one of the ways to do that is to drive from one cohort to another and improve their credit health. So when you think about how do you accomplish this, you need some things that are out there. You need actionable guidance for your members. How do you pay down debt? How do you raise your FICO score? How do you prepare to buy a home or an auto or school or for personal loans? Give them engagement pathways, and integrate them with a credit union's brand experience. All of this you're going to want to be able to deliver to them so that they can begin those steps towards improvement. Now, the benefits are, in many ways, we talk about that benefits are obvious, that we're able to, benefit our members from a financial standpoint. But the benefits to the credit union are dramatic as well. It allows for continuous member touch, better engagement with our members. It allows for proactive credit health improvement, which, as we've talked about, offers them an opportunity to take advantage of more credit union solutions. We can build on cross-sell opportunities, help make them more loan ready. And then we can measure outcomes such as score improvement and product uptakes and member loyalty, et cetera, that help then allow us to come back in and deliver the results that the financial education is delivering for the credit union. And then, of course, why it fits. Well, we know it's the right thing to do. We know it's important, but it also helps to align with the credit union strategy that you may be targeting for 2026 and beyond, to help deepen member relationships. To maybe you've got some risk that you're trying to reduce, increasing the asset quality, enhancing personalization. I hear over and over and over again about how important personalizing engagement is and how challenging that is as more and more members move to a digital environment. How do we enhance personalization? This can help you do that. And then it helps people accept the digital service models that we're working to deliver for them. So all of these are the benefits and what is needed in order to help move the needle with these folks. So when we start talking about, what do you do? The first thing we want to look at is set up an integration within the marketing channels, right? Marketing plays an integral role. It is the, most important part of engaging with our members on a macro level. So we will look at new members and have the credit union team look at new members within or existing members within the cohorts that we've outlined as your organization has outlined. The marketing team will identify those cohorts, and then talk and look at aligning the content and education modules to build that credit loan readiness awareness. And that's something that we can assist with. Then as we look at the different modules, we have the interactive learning, whether that be videos and quizzes. We have simulators such as calculators that help with if-then scenarios to give people an understanding of what happens if I do this. Blog articles to help build understanding and healthy credit strategies. We have there are podcasts that are out there that allow for a deeper dive into a topic rather than a blog, which takes 3-4 minutes to read. You can get really deep into a subject with a podcast. All of these are ways that you can deliver this sort of information to your members and begin to help educate them on how they can change their behavior and improve their credit situation. And then, of course, right, nothing happens without data. We need to know what's happening. So you work to build the system so that members are incented to log in, to complete the modules. You can track the product adoption by cohort groups. You review the metrics regularly and course correct as needed, and then work to optimize that educational experience by seeing how the members are engaging, what they're engaging with, taking that feedback and just continuously improving. So that's how the idea of getting started within the deployment and engagement platform looks like. So let's talk about the educational value to the credit union. So the first value channel is improving the credit union health with cohort A, taking those folks from 660 to 690 and moving them up into the 700s range up to 740. Even this incremental score lift will help credit health improvement. Through credit health improvement will mean fewer delinquencies, fewer defaults, lower loss provisioning, and improved net interest margin with a lower cost of funds or through pricing flexibility that you have. We know that financially literate members are less likely to default and more likely to use products responsibly. That makes sense. It's just kind of one of those obvious points, but it's not necessarily as obvious if you think about it. We have credit union members who are fully financially literate who still struggle, right? And so we want to make sure that we're delivering information and resources that help them be more financially literate to help them see what's going to happen both on the positive and negative side of certain if there are certain behaviors that they abide by. Then we talk about the value channel, that channel B, and we talk about the new loan origination and lifetime value, which allows for additional asset growth within the credit union. So we take this cohort and we're targeting them to move them above 660. It helps boost their credit readiness. They become eligible for new lending opportunities, whether that be in the auto, personal credit card, mortgage, etc., that they would not have qualified for at the lower credit score. And they are also eligible for better rates, which for them it means a healthier credit, and for us improving, it helps to improve that margin. So as TransUnion has shown that members using credit education, um, 10% of them open new accounts within the credit union within 90 days of utilizing and becoming regular users of the credit education. So you have an immediate 10% on new accounts within a space if they're able to asset or utilize the credit union's financial education assets. And then we know that combined with better retention, that the members feel supported and more loyal, and that can help lower acquisition costs and attrition costs because the only thing more expensive than getting a new member is losing a member, right? It's just a very costly when we have members that migrate to other financial resources, other financial service providers, whether that be the neobanks or a large bank or a community financial institution in our community. Anytime we lose a member, it's very expensive for us. And we've got to not only replace the revenue and the financial benefit of having that member as a part of our organization. Just to get back to even, we've got to spend the dollars to acquire new members and bring them on board. So it's a double whammy, and we want to try to avoid that. We know that when members are using credit education and feel supported by their credit union, they're much less likely to leave us. Now, how do I get to these magic numbers, right? This wasn't done in a vacuum. When we talk about the ROI, what's the value summary, and how do we quantify? This isn't qualitative. This is quantitative, right? It's not feel good and we should see and etc. These are real numbers. I used an annual investment number of $50,000. If you look at that, that would kind of be all in, including the platform, including your marketing efforts, and the time and energy it would take from your marketing team to do these, take these steps to set this up. That's probably a little high, but it's a nice round number and one that we can work backwards from pretty easily. So we think about what are the values to doing something like this, to really focusing on a program like this. Well, within cohort A, the risk upgrades and the incremental net interest margin on a 50,000 on a $50,000 investment within that cohort uh, results in a net increase of about $30,000. Within the cohort A, again, member lifetime value and the cross-sell opportunities equal around $40,000 a year in increased revenue. And then within cohort B, when you drive that asset growth through incremental interest driven by new loan opportunities, that's upwards of $75,000. And that's again per year. And then that member lifetime value and cross-selling opportunities can bump it another $25,000. So using a $50,000 investment, that total incremental value is about $170,000 between those two cohorts, which is a 3.3% return on investment in 12 months. Now, again, $50,000 is just a number. We can move that down as you look at what's available to you. And then those results are, those are examples. They may vary. But even if you get a 2% return, a 2.2% return on investment in 12 months, or a 1.5% return investment on the 12 months, it's still a positive investment. It's still a good use of spend. And it goes on and on. It's compounding as that program scales and you begin to expand your reach beyond just these cohorts. You look at other cohorts you want to engage with. You see members' behavior improve, and the platform becomes a standard within your organization. And that incremental, you get incremental returns from that. I haven't outlined that in the total return on investment piece, but we know that that can happen, that will happen. And then there are other non-financial benefits such as enhanced member engagement, a better brand position for you, goodwill, and then financial wellness becomes a member service. And it also gives you deeper data insights into your members. None of those things are factored into the return on investment, but all of those things are value drivers for the credit union to be able to tell a more compelling story about what it is that they're doing to support their community. So we know that among members who use a credit education dashboard, that 30% of them improve their credit scores by 21 points or more within a year. 18% improved by more than 41 points within that same year, compared to just 15% for non-users. This is from TransUnion and how a report on how National Credit Union drive member engagement with credit, their product Credit EDU. All right, another case study. Educated members tend to be more active and responsible. They're less likely to default on loans. From CU Insights, well-informed members can make smarter decisions. Credit unions that go that extra mile, they benefit from increased loyalty, lower risk, and increased revenue. That's from an enriched article on why CU credit unions need to focus on education initiatives. Study after study has shown that financial education, credit health, and wellness viability help mitigate risk and grow levers of success and grow levers of growth. How quantifying that has always been the challenge, and that's why narrowing down our initial engagement to a couple of cohorts that we can really keep a close eye on, really see what the results are, really see how they're engaging and how their engagement changes and how their opportunities change within the credit union. That gives us the way to go back and tell our leadership, this is the needle that we moved as a result of this investment. This is where we've seen real improvement in certain numbers that are important to us, drivers that are important to us. And that's why we need to continue with our financial education engagement. So when we think about a timeline and the budget, right, we think the timeline within the first month, you can have that set up and integration, working closely with your team, you garnering that member data to really get those cohorts built as to who we're going to target, and then set up the site so that you're able to deliver once you're ready to begin engaging. The second part is then onboarding those members within those targeted cohorts for both A and B. That's done within your marketing organization to help, and we support that. We'll help with that through marketing campaigns and member communication, targeting specifically that member, telling a story to them that's very personalized, and again, helps with the personalization component of what you're trying to accomplish. And then as we move through the year, through months 2 through 12. We know that this engagement will help drive credit health, but we monitor and optimize that content so that we're continuing to see that needle move, so that we're continuing to see that cohort improve overall and be able to start taking better advantage of the resources that we have as a credit union for them. And then we can begin to measure, because we have that data, that cohort A, we saw X number of people move from 660 to 730. That increased our numbers in this way. And because you can look at each individual member who's participating within that cohort group that you're targeting. So it gives you a way to really measure and resource what impact you're having within your credit union member space. Some key metrics and success indicators that you want to focus on is what percent of the cohorts that we're targeting actually engaged, are participating. What content are they engaging with? How many unique visitors per month? How many modules have been completed? How's the average time spent, and what device did they use to come in, and what days of the week are most engaging for them? What was the content that was consumed? Is it more around, was it more calculators? Was it more credit card questions? And you can begin to refine what you're offering to folks. And then measuring is important, right? What happened within the credit union, within those cohorts? Did their average FICO increase go up? Did the delta of the number of members improving more than 20 points increase? Did we see that credit health improvement that we promised? Did we see a reduction in charge-off or delinquency within those cohorts of members that are engaged versus non-engaged? Did we drive new loans? Let's measure that, see if we're seeing the loan in origination increases that we expect to see and that we believe we will see from this. Did the average loan size increase, et cetera? How are we doing within retention and attrition? How does net interest margin look, and how does that improve? And then we continue to just build on that information to show the ROI calculation. Did incremental interest income, provision saving, cost of program, all of that is the net benefit and cost, and allows you to be able to tell the ROI story. The critical component of this is not trying to just not have a financial education platform that you're making available to everybody, although it will be available to everybody, right? It's out there. But the key is to really target those cohorts and have this engagement with those cohorts to help move the needle specifically with them. And it doesn't have to be the cohort that I laid out here. You could target other cohorts. Could be new members. Could be young members that are under the age of X. Could be recent college graduates. Could be people approaching retirement and want to make sure that they're set up for the best possible success when they retire. You can build the cohort that you want to target based on what's most important to you as a credit union and what you think is most important to your members and who could benefit from something like this the most. So cohort A and cohort B in our examples are just that, examples. We can move and target other cohorts and work with you on that. So key takeaways that we want to talk about, and then I'm going to show you just show you how we got to some of these numbers, right? So that you don't think I'm just conjuring up numbers from the top of my head. We know that financial education is not just philanthropic. It's not just the right thing to do, which it is, but it's not just that. It can be a strategic pillar for you to help improve your overall engagement and your overall relationship with members. Net interest margin, increasing loan origination, and member long-term value. The industry case studies that we have support that credit education can improve member credit scores, engagement, and product uptake, which then improves all the things we're talking about. It reduces the risk of attrition. It increases net interest margin. It increases higher quality assets, which are all beneficial for the credit union. And then it's a relatively small investment, whether it's that $50,000 number that I referenced, or we downsize that a little bit depending upon things. It's not a large investment, but you can expect a nice ROI in year one and then compounding value thereafter. And that's one of the things that is nice about this is it's a gift that keeps on giving. That first year investment and return on investment is probably going to be the lowest that you see when you roll something like this out. If you continue to build within it, if you continue to utilize it, if you continue to expand your use cases and your cohort engagement, you're going to continue to see an improved ROI year over year. So, real quick, I just wanted to show you within cohort A and then cohort B, we're not talking about a huge number of people. In the case of cohort A, we are talking about 100 members that are in that near prime component and the impact that that has on the average loan balance, net interest margin, loss provision savings, and the annual financial benefit. And I will make sure that the team has this presentation if you would like it so that you can utilize it internally if you want to review some of the information. Within the cohort B, again, we're only talking about 100. We don't have to limit it to 100, but for our example, for our financial examples, we're only moving the needle with 100 members in both cohort A and cohort B. Now, maybe it takes us engaging with 500 members to do that because only 20% engage or 30% engage, whatever the number is. But we're not talking about having to have some overwhelming response. We're talking about 100 members that are engaged within this platform that will lead to the results that we're seeing. So we work together, we work with your marketing team, and we work closely to make sure that we're doing everything we can to help you engage with those members, to garner those users that are participating, and then to help drive engagement with them, improving the metrics that we talk about today. So this is, again, total value streams. We talked about these in the other parts of the presentation, but this is, when we think about, we're talking about two distinct financial channels and what those values are to the credit union over time. I do have one question from Lima. Can you explain how we can monitor the credit score? So depending upon the resources that your credit union has, sometimes if you're working with Experian, TransUnion, or Equifax, there may be some scoring solutions that you have out there. We don't necessarily through the financial education resource have access to credit scoring. We do through our other platform, which is called One Click Financial, which is a member personalization platform. But we can talk about how we can help you find resources that may be able to provide that. It really is dependent upon what resources you as a credit union might have in order to know those scores. Some credit unions know the credit score of basically all their members. Some do not. We can talk through what you might need to make that happen. Sorry, I don't have a credit score button within the platform, Lime. I'd love to do that. It's an enhancement. We are actually talking to Experian about ways we can enhance both our one-click platform and Evergreen through having that sort of resource available. But I've spent a lifetime in sales, in particular technology sales. There's nothing I hate more than vaporware, things that don't exist that people like to talk about. So I'm not going to try to tell you that we have that, but we are trying to figure out how we can improve that for those credit unions that might not have the resource. We'll continue to improve on it, but until then, we can talk about it within your particular situation, Lima. Thank you.
Eric, thank you so much for presenting with us today. And if anybody has anything else, or if nobody has anything else, we'll end the session. So thank you.
Thank you, Amanda. Thank you, everybody, for your time and your attention today. Excited to work with the CCUA and just thrilled that we're able to get this information out. And we'll continue. I'll be out at FinTech Connect. So
Great.
hopefully I'll see a few of you there. I'll be at the Apex in October. I'll see a few of you there. And then I'm trying to figure out how to get out there and do other things to support the CCUA and all of the credit unions within that league and that association. So thank you. Have a great week. Stay warm. I know I'm going to be working to do the same thing here in Michigan.
Great. Thank you so much, everyone.
Bye all.